Yeah, I think Warsh delivered on what the market participants wanted. Number one, he gave some view of the economy, which I think was important. He indicated that it was strong, it was resilient. That's how we all feel. I love that he talked about profits because that's incredibly important for us as investors. I love his commitment, once again, to the 2% inflation target, reiterating that that's something the Fed is laser focused on and not backing away from. And I think, you're seeing this sort of stability in the equity markets because we got what we needed from this speech.
Stability in equity markets, even if there is a hike. I mean, this is sort of the interesting note. You are seeing the expectation for a Fed funds rate hike for the September meeting go from before the hike at something like 35%, or before the speech to something like 35%. Now we're up to about 50%.
Yeah.
Is this acceptable right now? That's not necessarily going to take the froth out of equity markets.
Look, I think we should all expect September is a live meeting. We like the kind of 50-50 probabilities at this point because we don't exactly know how the data will come in, especially the CPI print that'll come in a couple weeks. I don't think the equity market is as sensitive to higher rates as the economy is. And I think that's the key driver here. Look at this quarter after quarter of double-digit blockbuster earnings growth, incredibly high revenues, raising guidance. I mean, that kind of momentum is not going to be derailed by a couple 25 basis point hikes in policy
Thank you. That's right where I wanted to go. And the heritage of this, folks, is Willem Bouder and Catherine Mann, who was just with us, now with the Bank of England, driving Citigroup economics. And now you've got Andrew Hollenhorst, who was way out front on higher rates and somehow will survive them. What I didn't hear in that speech was a discussion of the buoyant nominal GDP we're living now.
Yeah.
And the stock market is looking at nominal NVIDIA GDP and saying we can handle Warsh's higher rates.
We can. And look, we're really constructive on productivity growth. I think that's an important message. We heard
now or 5 years from now?
I think now to 5 years from now. Of course, as we know, forecasting 5 years from now is incredibly difficult. But we are seeing productivity growth. We think we're going to see more of it over the next 12 to 24 months. And I think some of that's getting priced into not just yields, but obviously into equity expectations as well.
Right now, there is a feeling that Chair Warsh is impatient. You are seeing this in markets if you are just joining this. The key line was when Fed Chair Kevin Warsh came out and said, here is our standard. We must be confident that underlying inflation is moving to our objective clearly and at a sufficient speed. Otherwise, we have work to do. Kate, does he lose the credibility if the FOMC does not hike in September?
I think the Fed needs to continue to be data dependent. And
what does this mean? Because we just got data and it was disinflationary. Does that mean they don't hike? But at the same time,
we know we're looking at a several-month trend in terms of the inflation. And I just felt a lot of comfort from the message today that it's not going to be about a single print, that it's going to be about this kind of moving average, and that the Fed is committed to 2%. Look, if they don't hike at all in the balance of this year, I think they lose a lot of credibility. If it's September or October or later in the year, I think we can split hairs over that. But no hikes at all after this type of message would be a challenge. But September in and of itself doesn't change the credibility of the Fed.
Do they need to take back the 75 basis points of hikes that they delivered after the last FOMC meeting here in Jackson Hole?
I mean, there's a lot of stuff that needs to come out. And of course, we have to bring into the conversation the fact that we have midterm elections. And although the Fed is going to be apolitical to the extent that it can be, we do know that consumer behavior sometimes changes ahead of elections and that there's going to be a lot of noise. I expect a decent amount of volatility in the equity markets over the course of the fall because of policy, because of earnings, and because of the election.